As we enter the fourth quarter of 2025, the biotech sector faces a complex landscape of opportunity and challenge worth examining closely. Three forces shape today's biotech market: policy pressure from new regulations, selective capital from cautious investors, and beneath the volatility, a quiet rebuilding of confidence. After a steep April sell-off, the Nasdaq Biotechnology Index climbed back more than 30% by October, outpacing broader markets in a remarkable recovery. Policy uncertainty ripples outward. The Inflation Reduction Act and drug import tariffs reshape pricing expectations, push companies toward US manufacturing, and strain balance sheets. But several risk factors could still disrupt this momentum. Tariff escalation, renewed IRA enforcement, government shutdowns, budget delays, and rate shocks all converge to threaten investor sentiment and drain liquidity from smaller biotech names. Beyond the market turbulence, mRNA technology is evolving into something far bigger than COVID vaccines. mRNA gained fame through COVID-19 vaccines, but it's now establishing itself as a versatile therapeutic platform with applications spanning multiple disease areas. The biotech capital compass has evolved too, transitioning to a new publishing model. After a 3-month free run in late 2024, the publication launched its paid model in January 25, now focused on building an engaged subscriber community. This analysis comes from someone who's navigated biotech's ups and downs for decades. Hartaj Singh brings over 30 years across drug development, investment strategy, hedge fund management, and biotech analysis, experience that informs every insight shared here. How has biotech actually performed through this turbulent period? On October 10th, the S&P 500 dropped 2.7%, yet biotech outperformed modestly, a contradiction that reveals the sector's relative strength. Beneath the headlines, capital is quietly flowing back into biotech. The capital market recovery shows three key signs: ETF inflows into XBI and IBB, follow-on issuance reaching $2 billion, and hedge funds raising their biotech exposure. Convertible and structured deals made up nearly a third of capital raised, directly reflecting investor demand for downside protection. Yet broader economic and policy forces continue to weigh on the sector. Policy risk, not scientific uncertainty, acts as the main constraint, reshaping pricing expectations, driving focus toward domestic manufacturing, and compressing investor multiples heading into Q4. Platform technologies with proven mechanisms attract selective venture capital, while preclinical story stocks face the opposite reality, struggling to find sponsorship. The regulatory environment has shifted dramatically this year, creating both setbacks and opportunities. The FDA's pause on Sarepta's Elevidys program triggered heightened safety scrutiny across AAV vectors, chilled sentiment temporarily, then accelerated constructive dialogue around better risk management frameworks. New FDA initiatives, including platform technology designation and guidance for small population trials, promise to enable next-generation modalities, shorten timelines, and improve predictability for developers. Performance across individual biotech stocks tells a story of extreme dispersion. The bar chart reveals dramatic extremes: Amylyx up 277%, Graphite up 270%, Unicure up 200%, while Pliant and Sarepta fell 82%, showing how the market rewards catalysts and punishes missteps. Dispersion, not direction, remains the defining feature of this cycle. Three strategic themes will shape how investors position through year-end. Investment positioning for Q4 branches into three approaches: prioritizing quality companies with strong balance sheets, focusing on policy-resilient businesses, and exploiting technical dislocations from year-end selling. Companies with balance sheet strength and transparent communication attract institutional support even in choppy markets, showing how financial discipline translates directly to capital access. Companies emphasizing domestic manufacturing and simplified supply chains receive capital rewards, while those with cross-border complexity face penalties and discounting as policy remains unpredictable. Year-end follows a predictable pattern. Tax loss selling creates price dislocations in quality names, patient capital identifies entry points, then the January effect produces rebounds once seasonal pressures fade. Beyond fundamentals, mechanical and behavioral forces distort biotech prices in the final quarter. Tax loss or selling peaking between mid-November and Christmas targets small caps, mid caps, and underperformers, creating mechanical selling pressure unrelated to business fundamentals. The January effect flows capital back into those same oversold names, producing sharp, early-year rallies concentrated in the most beaten-down corners of biotech. The heightened volatility in Q4 2025 doesn't signal fundamental deterioration. It reflects an anxious market processing incomplete information, rather than actual business impairment. Quarterly earnings play different strategic roles depending on the season. Q3 earnings focus on profitability peaks and year-over-year growth, while Q4 earnings serve the opposite purpose, bridging operational results with forward guidance and 2026 expectations. 3 tiers face earnings scrutiny. Large caps like Gilead and Vertex, mid caps such as Alnylam and Sarepta, and small caps facing funding constraints, though each faces different investor expectations. A practical 3-point framework can guide positioning through the final quarter. The Q4 strategy branches into 3 principles: favor companies with visible catalysts and transparency, lean into businesses with policy resilience and domestic focus, and exploit technical dislocations from year-end selling. The year 2025 resembles prior bridge years like 2004, 2014, and 2020, where macro uncertainty masked underlying improvement and recovery quietly assembled beneath turbulence. The technical picture tells a story of resilience and recovery over the past year. The NBI's one-year journey shows a sequence, hitting lows near 3,700 in April, enduring regulatory shocks through summer, experiencing gradual sentiment softening, then rallying to over 5,000 by early October, a 35% rebound. The NBI's ascending structure sits comfortably above 3 key moving averages: the 50-day at 4,761, 100-day at 4,180, and 200-day at 420, signaling fully aligned bullish trend confirmation. The MACD remains positive, confirming trend strength, but shows signs of momentum cooling as the histogram flattens, an early signal after a 20% summer rally. Each pullback since April finding support at progressively higher levels reinforces a pattern of accumulation rather than distribution, signaling institutional re-entry focused on valuation normalization. The shorter-term 3-month view offers a closer look at recent momentum. The 3-month chart shows a sequence, establishing a base at 4,180 in early June, forming tight consolidations, experiencing shallow pullbacks at moving averages, then reaching a peak at 5,060 in October, a 20% gain in 90 days. The 200-period average at 4,950 serves as critical near-term support, marking the level that distinguishes tactical profit-taking from trend reversal. The MACD dipping slightly into negative territory for the first time in months signals short-term exhaustion after months of gains, though this appears mechanical rather than a breakdown. Sentiment becoming event-dependent, with investors rotating around catalysts rather than exiting wholesale, creates a self-correcting market where sell-offs are short-lived and buying resumes once risk clears. The short-term picture points to consolidation, not capitulation. Bringing together the 1-year and 3-month views reveals biotech's current technical position. The NBI's 2025 rally has been disciplined rather than speculative, shaped by capital rotation among subsectors and driven by policy recalibration rather than euphoric momentum. 3 technical elements remain constructive. The pattern of higher highs, higher lows, and rising moving averages all indicate the uptrend structure stays intact despite near-term cooling. Biotech sentiment has evolved through a sequence, moving from a fear phase earlier in the year, transitioning to cautious optimism by fall, and now facing the Q3 earnings test that will determine if momentum can sustain. Biotech is no longer fighting gravity, it's managing altitude. The analysis draws on a range of data sources and market benchmarks. 5 major index and ETF tickers serve as key market benchmarks: NBI, XBI, IBB, ARKG, and SPEX, referenced throughout the analysis. 5 large-cap biotech companies anchor the earnings and performance discussion: Gilead Sciences, Biogen, Vertex Pharmaceuticals, Alnylam Pharmaceuticals, and Sarepta Therapeutics. 4 companies exemplify extreme performance dispersion: Amylyx, Unicor, Graphite Bio, and Pliant Therapeutics, representing both the biggest gainers and losers year to date. 5 key acronyms appear throughout: FDA, IRA, AAV, MACD, and SMA, covering regulatory, policy, and technical terms essential to the analysis. Transparency requires clear disclosure of the publication's purpose and limitations. This newsletter is for informational purposes only and does not constitute financial, legal, or investment advice. Forward-looking statements fall under the safe harbor provision of the Private Securities Litigation Reform Act of 1995, indicating they involve risks, uncertainties, and assumptions that may not materialize. Potential conflicts of interest include holdings in BBE ETF, BPP ETF, IBB ETF, and XBI ETF, as well as occasional consultancy arrangements that may involve financial compensation or equity ownership. The trading blackout period, preventing the author from trading mentioned stocks within a specified period before and after publication, reflects the commitment to transparency and avoiding conflicts of interest. Biotech Capital Compass is not responsible for any investment